I now declare the polls open on items 2 to 5, and I encourage shareholders to begin submitting their questions ahead of the formal business of the meeting. But let me begin with a review of financial year 21 and where it positions us today. In a year that began with so much optimism, it quickly became obvious that COVID disruptions would again weigh heavily in 2021. And as we sit here today, while there are reasons for optimism about the economy, there remain many ongoing challenges. Pleasingly, vaccination rates in Australia and New Zealand are world-leading, and domestic borders here in Australia are reopening, most in time for the Christmas holiday period. Moreover, the overall economy in Australia and New Zealand has remained in remarkably good shape, with all the indicators pointing to a solid rebound. However, there will, of course, be issues to manage. Tourism and hospitality have had a tough 2 years. In addition, inflation, driven by supply chain bottlenecks and the strong housing markets in Australia and New Zealand, is creating policy challenges for governments and for regulators. Unemployment has risen slightly, yet at the same time, the lack of overseas migration has contributed to staffing shortages in critical sectors. As the economy opens up again, we're proud of the way ANZ has supported those in need through the pandemic. In the early days, we rightly prioritised supporting those who had been most impacted by the various lockdowns, notably with loan deferrals. These deferrals, which rolled off during the year, provided tens of thousands of customers with the critical time required to manage their cash flow through the lockdowns. Likewise, we took action to ensure our people across our entire international network were well supported, and the board is pleased with the continued positive results we're getting from our employee engagement surveys. So let me talk a little bit now about the business performance in financial year 21. From a bank perspective, the year demonstrated the benefits of a diversified portfolio as we successfully navigated the continuing impacts of COVID-19 whilst also providing solid returns for our shareholders. For the 2021 financial year, we posted a statutory profit of $6.16 billion, which was up 72% on the prior year. But whilst this was a pleasing outcome, it's important to recognise that the main driver was the partial reversal of COVID-19 related credit provisions. If we look through the impact of those provisions, profit was flat year on year. But actually, this does reflect solid management of the bank through this unprecedented crisis. As a result, we were pleased to pay a total dividend of 142 cents. This is up from 60 cents last year, and it's meant that more than $4 billion was returned to you, our shareholders. This was a particularly pleasing outcome, given the heavy burden on investors through the pandemic as the banking sector stepped up to support customers and the community. Now, last year I stressed to you that your board would be focused on 4 key areas to improve shareholder returns. In particular, the efficient use of capital, improving customer outcomes, reducing the cost to run the bank, and the continual improvement of our culture. And I think it's important to report to you today on our performance, and I'm pleased to let you know that we've made solid gains in all of these areas. Let me start with capital management, which remained a highlight. We are now one of the most strongly capitalised banks in the world, with a Common Equity Tier 1 capital ratio of 12.3% at the end of our financial year. And to put this in a broader perspective, this is $6 billion above APRA's unquestionably strong measure. Very importantly, we achieved this without the need to dilute existing shareholders by issuing new shares in order to raise additional capital. In fact, our intense focus has led to ANZ delivering sector-leading total shareholder returns over the 12 months to the 30th of September. And we achieved all this while returning additional capital to shareholders and paying a dividend more in line with our long-term payout ratio. Let me turn to the second area, which is costs. And we recognise the industry will continue to face downward pressure on margins. And while we were early to this understanding, and indeed we've led the industry in this regard, we are maintaining relentless pressure on our cost base. I'm pleased with the focus of the management team. We were the only major bank to reduce the day-to-day cost of running the bank, allowing us to invest in new initiatives at a greater rate than our competitors. Looking at a third area, customer outcomes, we recognise that we need to better anticipate and ultimately make faster and smarter credit decisions. This year, major increases in demand for home loans in Australia impacted our ability to process applications in a timely way. And unfortunately, this resulted in a loss of market share, which, to be frank, was a disappointing outcome. Naturally, this has been a major focus for the board and management, and we are confident that the systematic actions being taken by management will address these issues. And these include increased investment in automation and process improvement. As a result, we expect our Australian home loan portfolio will return to growth in this half, and that ANZ's growth will be in line with system growth sometime in the second half of this financial year. I think it's important to note, however, that margins across the group were well managed in what was a challenging environment. The events of the past 2 years also highlighted the benefits of a strong culture. We maintained very strong staff engagement, despite the majority of our people working remotely, and we attracted hundreds of engineers and data scientists, many from companies like Apple, Amazon, and Square, to help completely rebuild ANZ's digital capability. And above all, while there is still more to be achieved, we also made the strongest improvement in gender diversity in several years, with female representation in leadership roles increasing by around 2 percentage points to 35.3%. So if I summarise our performance in financial year 21, we strengthened our balance sheet, we returned to long-term dividend payout levels while funding a share buyback, we led the sector on cost management, our staff remained highly engaged despite COVID-induced disruptions, and we continue to invest in new digital banking platforms which will radically improve customer and staff experience. However, the environment remains uncertain and highly competitive, and there are many challenges ahead. We recognise we have more to do, particularly in the home loan processing space, but we have made good progress in building a bank to better compete in a highly competitive, fragmented market. And Shane will shortly discuss the work we're doing to address these challenges through our ANZX program. Let me turn now to resolutions, and I also want to give you the board's perspective on some of the resolutions being put to the meeting today. And I'll begin with the adoption of the Remuneration Report. Ilana Atlas, who's the chair of the Human Resources Committee, will talk specifically to our approach, but given its importance to many shareholders, I feel it is appropriate that I also make some initial comments. On the whole, management had a good year, either exceeding or meeting most of the objectives set by the board. Profit was up, capital management was strong, and New Zealand and Institutional had particularly good years. But there were challenges, and this is reflected in the final outcomes for our disclosed executives, with the average variable remuneration being around 60% of their maximum opportunity. The board believes this has struck the right balance, considering all that was achieved this year, including our strong margin performance. The other resolution I want to specifically address relates to climate change, and in particular our lending to the natural resources sector. We recognise the most important role we play in enabling the transition to net zero by 2050 is to work with our customers to reduce their emissions. This is not new for ANZ. We have led the Australian banking sector for several years with a focus on engaging with 100 of our largest emitting business customers, with a $50 billion sustainable financing target, and with industry-leading climate-related disclosures. We know our stakeholders want further clarity on how we're aligning our lending portfolio with the Paris goals. And this year, ANZ became the first major Australian bank to join the global Net Zero Banking Alliance. In line with this commitment, we recently announced new emission intensity reduction targets and pathways for 2 key sectors, power generation and large-scale commercial buildings portfolios. For our power generation portfolio, our target is to achieve a 50% emissions intensity reduction by 2030. And for our portfolio of large-scale commercial buildings in Australia, we have set a target to reduce emissions intensity by 60% within the same time frame. And we'll progressively expand these pathways to other key carbon-intensive sectors, including oil and gas, in 2022. While we're embracing our role, I accept that there will be some listening today who feel we are not doing enough to act on climate change. And paradoxically, there will be others listening who think we are moving too fast. Specifically, there are some who would prefer that ANZ no longer lends to fossil fuel companies at all. Such a ban would likely force these companies to source finance from banks that are less committed to emissions reduction. ANZ's policy, however, is clear. We will only lend to energy companies with a target-driven, publicly disclosed plan to reduce their emissions in line with the Paris goals. We believe this will encourage and support companies genuinely committed to a lower emissions future. Of course, we know it will take some customers time to develop and implement their plans to reduce emissions. However, my message today is we're prepared to work with those who are committed to driving this change. And that is a far better result for the community than simply washing our hands, walking away, and pushing these companies into the hands of less responsible lenders. We believe this will also encourage and support companies genuinely committed to a lower carbon emission future. Ultimately, the role of the board is to ensure we are taking a prudent, measured approach, and we feel we have considered the needs of our customers, investors, and the community in our transition plans for a lower carbon future. Now, at the conclusion of this meeting, we will be saying goodbye to one of our long-standing directors in Paula Dwyer, who is stepping down after 9 years of dedicated service. Paula is one of Australia's most respected non-executive directors, and we've been incredibly fortunate to have her serve on our board, particularly in her role as chair of the Audit Committee. Paula, we thank you for your service to the bank, and we wish you well for the future. We are, of course, very pleased to be able to welcome Christine O'Reilly, who will be standing for election later in the meeting. Christine is an outstanding company director, and her extensive experience makes her the ideal director to take over as chair of our Audit Committee. Christine will address the meeting directly, but I know, if elected, she will make a significant contribution on behalf of all shareholders. Finally, it's reassuring to know we have a dedicated workforce of more than 39,000 people working hard every day for all our stakeholders. On behalf of you, our shareholders, I express our thanks to them. I'd also like to acknowledge our customers for again trusting us with their business, and you, our shareholders, for supporting us through the year. Your support is much appreciated by the board. And with that, I will now ask our Chief Executive Officer, Shayne Elliott, to address the meeting. Over to you, Shayne.